We held ourselves up as the experts, and the loss of public confidence from failing to live up to those expectations that we created will take years to rebuild. Worse, decisions on compensation and other actions taken and not taken, particularly at banks that rapidly lost a lot of shareholder value, look self-serving and greedy in hindsight. Financial institutions have an obligation to the broader financial system. We depend on a healthy, well-functioning system, but we collectively neglected to raise enough questions about whether some of the trends and practices that became commonplace Everybody have that now?
Hi, sir.
How are you?
Fine, thank you.
Good.
We'd like our money back.
What? Okay. How about this? I'll address that at the end. They've seen it, and then I'll address that at the end if you get off now.
Thank you.
Okay. What? Well, that's my proposal, but, you know.
If you could address it now, that would be great.
No, I understand, but. Meaningful change and effective reform are vital and should naturally emanate from the lessons learned. I'll discuss a few of the more important lessons from this crisis. I'd also like to highlight some of the regulatory guideposts that may help us to improve the broader systemic management of risk, increase the level of institutional accountability, and enhance investor confidence. Without trying to shed one bit of our industry's accountability, we would also further our collective interests by recognizing other contributed causes to the severity of the cycle we're living through. As a matter of policy, we allowed housing prices to be subsidized, including through implied government support of Fannie Mae and Freddie Mac. We watched as high consumption and low savings rates, as well as entitlement spending, were increasingly encouraged and financed through the twin deficits. Factors from both Main Street and Wall Street contributed to today's circumstances. Neither part of our economy acted completely independent of the other. So any examination of how we got to this point must begin with an understanding of some of the global economic and financial dynamics of the last 2 decades. Certainly, what started in a localized part of the U.S. mortgage market spread to virtually every corner of the global financial markets. But the genesis of the problem wasn't in subprime. Instead, the roots of the damage to our financial system are broad and deep. They coalesced over many years to create a sustained period of cheap credit and excess liquidity. The resulting underpricing of risk led to massive leverage across wide swaths of the economy, from households to the corporate sector to the public sector. I see at least 3 broad underlying factors. First, there has been enormous growth in the amount of foreign capital, much of it held in large pools, and a very significant shift in the balance of payments of many emerging markets. Second, and linked to this, nearly 10 years of low long-term interest rates. And third, the official policy of subsidizing homeownership in the United States. Let's take each in turn, beginning with the growth in foreign capital. Between 1992 and 2007, the U.S. current account deficit increased by more than 1,300%. During the same period, China's current account surplus increased by over 5,700%, as did the surplus for the oil-exporting nations. After previous financial crises, emerging economies began to self-insure against a repeat of those events by building up their foreign currency reserves. Their primary objective was to reduce their dependence on dollar-denominated domestic debt. Of course, the other, perhaps more significant factor in the growth in current account surpluses had been the record run-up in oil prices since 2000. Increases in global savings run almost parallel with the increase in petrodollar flows. The growth in foreign capital had a profound effect on the global economy. Foreign holdings of U.S. government and corporate debt skyrocketed. China's monthly average purchases of U.S. long-term securities went from less than $2 billion in 2001 to over $15 billion in 2007. The flood of foreign capital into safe and liquid assets, particularly U.S. Treasuries, helped push relatively low long-term interest rates down even further. And they stayed low, even after the Federal Reserve began raising short-term rates in 2004. This was accompanied by a significant reduction in inflation. Between 1985 and 1995, and the next 12 years, inflation-advanced economies fell by more than one-half. Enormous excess liquidity, strong global economic growth, and low interest rates created a desire to find new investment opportunities. Many of the best were thought to be in the housing market. The reasons are threefold. First, governments, particularly the U.S., explicitly supported home ownership through a variety of government programs and initiatives. Second, mortgage assets were considered relatively impervious to sharp downturns. And lastly, the creation of more flexible and varied mortgage products attracted even more capital in search of higher returns. These factors, to varying degrees, contributed to a housing bubble, not just in the U.S., but in many other countries as well. While real home prices increased nearly 50% in the U.S. between 1998 and 2006, they increased more than 130% in Ireland, 120% in the UK and Spain, and over 100% in France. Not surprisingly, in the US, mortgage origination as a percentage of total mortgage debt outstanding rose from an average of 6.3% between 1985 and 2000 to 10% between 2001 and 2006. Subprime debt in particular grew from just over 2% in 2002 to 14% in 2008. In a stained environment of cheap capital, lending standards for residential mortgages simply deteriorated.